What is happening, everybody? Welcome to another wonderful, amazing, spectacular episode of Ryan and Real Estate. Today, we are talking about what is actually in your mortgage payment. You write that check every month, or maybe you're thinking about getting a house and you're like, how am I gonna write that check? But I wanna help you figure out what's actually in it. The easiest way to remember what is in your mortgage payment is the four letters PITI. Which stands for, and we'll take each one separately. Number one is the principal. That is the principal of your mortgage payment. That is basically, say your loan that you took out was for $300,000. You're taking a portion of that $300,000 and eating it down each time you make that mortgage payment. The second letter is I. That is the interest. That is what the banks love. That's where they make their money. As you can see, these rates are kind of getting up there a little bit, but they take that from first, usually the very beginning of a loan. Say you have 30-year fix. Usually first 15 years, the majority of what you're paying will be the interest on that mortgage payment. And that is what you're paying. The bank is taking that and putting in that for the fee of giving you that $300,000. Thirdly, we have the T. It's everyone's favorite. Uncle Sam comes in and gets those taxes. Those taxes can be made up of your local school board taxes, water taxes, lots of different other taxes that are wrapped up in there. And that is based off of the appraised value of your home times the tax rate in your city location that you are at. You also want to talk, when you're talking to a lender, make sure when you're looking for a home, you understand how much taxes are, because that's going to play a significant role in how much your monthly payment is going to be. And then lastly, the other thing that plays a significant role is your insurance. You can have a $2,500 a year insurance payment. You could have a $5,000 a year insurance payment. Of course, that's going to play a huge difference, because that's basically divided by 12, and that's going to tack on that monthly amount to your mortgage payment. Now, how do you actually make those payments? You're gonna make those payments if you are have an equity position in your loan, in your home, more than 20%. Technically, you don't have to put all you have to do is pay the mortgage company the principal and the interest. You can actually pay the insurance and the taxes on your own. But most lenders, if you're under 20% equity position into that home, they're gonna take that money up front to make sure you don't miss those payments. And they're gonna actually put it in what's called an escrow account that you're gonna pay into that. They're gonna take, and when you close on your house, you're gonna actually pay for future amounts of the payments on those property taxes and insurance. So then when the bill comes up, it's actually your mortgage company that's making the payment to your property taxes and your insurance. Which, a little reminder, if you ever do decide to change insurance companies, make sure you let your lender know that, because they don't know unless you tell them, and they'll keep making those payments. All of those things combined are what makes up your mortgage payment. You can't really control the principal or the interest unless you refinance, but you can control and you can't really control the taxes either unless you appeal them. And you can control the insurance, which of course you can shop around to find, and we'd love to help you out with that as well, find the best insurance rate for yourself. That, my friends, is what makes up the mortgage payment. Once again, thanks for watching. If you have any questions, feel free to reach out. Also, don't forget to subscribe, get the notifications by clicking the bell, and we will see you next time on Ryan and Real Estate. See you later.